So this is chapter 14, part 4. We were just going through some of the ratio methods to analyze liquidity. We just finished that up. And one thing I think, just to go back and just to make note of, that there is always a trade-off. So if we look at the current position analysis, we see that our current ratio is 2 times. Our working capital is a positive 300. And the reason for that is because we had more current assets than current liabilities. And so from a liquidity perspective, that's a good thing. We like to see more current assets than current liabilities. However, when we go down into our our accounts receivable analysis and our inventory analysis, we do see that while accounts receivable look like they're handled correctly, we do see that, in fact, our inventory is likely too high. We have 104 days of inventory. So even though up above we like the idea of having a lot of current assets relative to current liabilities, when we come down below, our conclusion is that yes, while we do have a lot of current assets, we have too much inventory. And so that's a trade-off. We don't want excess inventory just for the sake of having more current assets, just for the sake of having better liquidity. We have too much inventory. That could be problematic. First of all, it costs us money, costs us investment, costs us perhaps carrying costs to carry that much inventory. And the second thing is potentially we're not going to be able to sell that inventory. We might have old obsolete inventory that's not selling, which is not going to be convertible to cash anyway. So we need to get that inventory in order, and we don't want to carry excess inventory just to make our liquidity look better. So in that case, there's definitely a trade-off here between the two, between having a lot of current assets, which looks good in our current position analysis, but which, when we look at our inventory analysis, is actually a bad thing. So just that's, again, something to keep in mind. Anyway, so the second set of ratios that we're going to look at is profitability ratios, or really looking at returns. And I can't emphasize enough that, again, really, it's not about absolute profitability, it's about return. And what is the return that you're making on the money that you've invested in your business? That's going to tell you whether that business is a good business or whether there might be other investment opportunities that are perhaps better. Okay, so I'm going to deviate from the book a little bit here. I'm going to insert a couple, really just, I guess, a couple ratios that aren't covered, that should be covered. I don't know why they are not covered in the book. They certainly fit in with the chapters, and certainly everybody uses them. So I'm not really sure why they're not part of this chapter, but I'll indicate where they are. So first ratio we're going to cover is the asset turnover. Okay, and that basically it's a measure of how efficient our assets are in generating sales. Okay, and if you look at the equation, it's really just sales divided by average assets. And so what this is basically saying is that for every dollar in assets, how many sales are we generating? Now, obviously, we'd like this to be as high as possible. We'd like to have the fewest amount of assets and the most amount of sales. Okay. Now, a lot of times sales aren't necessarily under our control. Obviously, we're trying to generate as many sales as possible, so it's not like we can just automatically generate 50% more sales. On the other hand, we do have some control over assets. We can configure our business differently, and so we do have some control over assets. And we just saw inventory is an asset where we might have too much inventory, purely because we've mismanaged inventory. So we do have the ability to control that number. Up in the upper right, we just have some figures here so we can work through some examples. So let's just fill those in. We have sales of 1,000 and average assets of 2,000. And so our asset turnover here is 0.5 times. Okay, so for every dollar in sales, for every dollar in assets, we're basically generating 50 cents in sales. Okay, and again, we would want that to be generally this ratio to be as high as possible. It would be great if we could have a business, and a lot of the tech companies are like this. Especially some of the social media companies where they have very little assets at all and generate tremendous amounts of revenue. So those are obviously high asset turnover businesses, require very little investment, and that's why they're so valuable. So the higher, the better in this case, okay? The second thing is, once we've generated those sales, then the question is, how profitable are the sales that we generated, okay? And so this is really a true measure of profitability, and it's called profit margin. And it's really just net income divided by sales. All right. So here we're saying in the first ratio, we have some assets that we've put into the business or we've invested in. They're generating sales. The second step is, okay, how profitable are those sales that we've generated? And so let's take a look at that. We've got net income of 100, and we've got sales of 1,000, and so we've got a 10% profit margin. And again, this ratio is not in the book. I'm not really sure why it's not in the book, but it is obviously probably the first ratio I think anyone would ever look at. So it's a little puzzling why that's the case. All right, so first two ratios basically involve generating the sale, and then once we've generated the sale, how profitable is the sale. So then we come to our return calculation. And now our return calculation is really just a combination of the first two ratios. Okay, so you can see asset turnover. And by the way, return on assets is, in effect, what is my return on the assets that I have invested? So I've invested some assets. What's my return on those assets? Okay. And really it's just a combination of the first two ratios. So it's asset turnover. That was the first ratio. And then profit margin was the second ratio. Okay. So profit margin times asset turnover is going to give return on asset. Return on assets is basically net income divided by assets. And you can see that those two ratios over here, I put them together. And really, if you multiply those ratios together, the sales would cancel out and you'd have net income over assets. But it's a way of decomposing return on assets into the two pieces that are really responsible for that ratio. So it's profit margin times asset turnover. Okay. So in this case, net income over sales. So our profit margin, remember we had 100 divided by 1,000. That was our 10%. And then we had 1,000 of sales divided by 2,000 of assets. That was our asset turnover of 0.5. And again, if we multiply those out, we're just going to get 100 because the sales cancel out over 2,000. Or 5%. Same thing here. If we were to multiply these out, 10% times 1/2 is going to be 5%. So a return on assets is 5%. All right, so you have to think, is that a good return, 5% on amounts that you invested in a business, considering the risks involved in a business? Doesn't seem like that's a very high return on the amount of money you have invested in your business. Okay, probably the reason is that even though your sales are relatively profitable, this 10% here is not bad. The problem is that your assets are very inefficient at generating sales. This is a very small number. 0.5 is not a high number, and that's what's dragging down your return. So if that number could be improved, then return on your assets could be improved. Okay, so that's return on assets. Now in the book, the full formula is net income, okay, plus interest. So when you get to the exam, make sure that you follow that formula in the book. I've just kept it simple here, okay? But the true number is you would add back interest expense to eliminate the effect of any kind of debt financing. All right, so then debt to equity, okay? And this is basically leverage, okay? This is using other people's money. Using other people's money to magnify the equity returns, okay? So, in other words, you're the owner, and what you're doing is you're borrowing money so that you can magnify the returns on your investment, okay? Not just the returns on assets, but the returns on your investment by using other people's money. Okay, so a good example of that is if you bought a house for $100 and you borrowed or took out a mortgage for $90, then your equity or the money that you would have to put in is only $10. So you'd have to put in $10. Let's say that the home went up by 10%. Okay, so the value of the home went up by 10% to 100. I'm sorry, 110. Now you pay off the $90 mortgage and you have $20 left over. Okay, your return, even though the house only appreciated 10%, your return was 100%. Okay, because your investment went from 10 to 20. That's 100% return, even though the house only increased by 10%. So this was a situation of using other people's money to basically leverage your investment from $10 to $100, and then you were able to gain the full appreciation. So it magnified your returns, and that's what leverage does. So same thing here in the company. We've got debt of $1,500. We've got equity of $500. So the debt to equity ratio is 3.0 times. So we're using 3 times as much of other people's money as our money. So we're using leverage, and we'll see what that does to our return here. So let me move this up. Okay, so basically net income to equity is the return on equity. Return on equity is, of course, the most important thing because equity is our money, the owner's money. And so return on equity is the return on the owner's investment. So net income to equity, net income was 100, equity was 500, and that was 20%. It's a 20% return. So if you remember, we went from 5% return on assets up here to 20% return on equity. And the reason that was magnified is it was magnified due to leverage, okay? And basically the equation for that would be the return on assets times 1 plus the debt to equity ratio, okay? And so that would give us return on equity. And so we can see that what we did was we had a 5% return here times 1 plus the 3 times, that's 4. And so that gave us the 20%. So you can see that leverage was a magnification factor of 4. It raised our return by 4 times. And companies use leverage all the time. Banks are sometimes 90% leveraged. Most other companies will not want to be that leveraged because of the risk involved in having that much debt. So that's a trade-off. Having the risk of bankruptcy by having this much debt, but on the flip side, it certainly helps to magnify the returns.